What if I'm self-employed?
What is a mortgage?
What is your
How does the
primary?
fixed rate
What's
work?
the number
How much do I need for a down payment? This video is about answering those questions. Welcome to the Rami Magic Show. Today's segment of Mortgage Science, we're going to talk about fixed rates versus variable rates. A fixed rate is simply a rate that is the exact same rate and the exact same payment, unless obviously you change it, for the length of your term. If you're on a 5-year term and you get a 1.69%, you have 1.69% for 5 years. That's simple. A variable interest rate is a rate that may fluctuate with the bank's prime rate, okay? Let's talk a little bit about that. So, fixed versus variable. Fixed is same rate for the length of the term, while variable fluctuates. But how does it fluctuate and how does it impact you? Normally, if the variable rate changes, and there's an opportunity for a variable rate to change up to 8 times per year, you will receive a letter from your current mortgage lender that will let you know that in 30 days, your payment will change. Now, there's 2 types of variable interest rates. There's one type where your payment will actually change, okay? There's another type where your payment will not change, but you are paying either more or less interest, okay? Now, fixed is fairly simple. Let's talk a little bit about variable. So the few key rates here, there is the overnight rate that is set by the Bank of Canada, okay? And then there is the prime rate that is set by each individual lender. Yes, normally there is a correlation. When the overnight rate changes, normally we do see a change in prime rate. However, sometimes the spread is not the same. Sometimes the overnight rate will reduce by 0.25%, while the prime rate will only reduce by 0.15%. And we've seen that a few times in the last couple of years. Now, if the prime rate, which is currently set at 2.45%, your variable rate is the discount. So it would say 2.45% minus a discount. This is the spread, okay? The discount is, let's say, is 0.8%. So it would be 2.45 minus 0.8, okay? The 0.8 is your discount. So your interest rate is 1.65%. If the overnight rate, which is currently set at 0.25, changes and the prime rate changes by your lender and it goes, let's say, down to 2.3%, then your interest rate will go down by 2.3% to 1.5. So it'll go down by 0.8 to 1.5% because it went down here by 15, it'll go down here by 15 as well. Okay? When you're deciding between a variable interest rate and a fixed interest rate, it's really important to understand this concept here. The fixed rate is simply an insurance. The spread is an insurance. Right now, the fixed rate and the variable rate are very close in interest. Because the fixed rate is so low, it'll be slightly better or slightly worse than a variable interest rate. So paying for that has a very small insurance. Normally, when the fixed rate is higher than the variable rate, paying for that spread is an insurance that protects you in case the rates do go up, okay? A few years ago, several people, when the variable rate started going up because the prime rate was going up, they called their lenders and they tried to fix that rate. Yes, you could do that. You can call your lender and say, I'm on a variable, I'd like to fix my interest rate. But you're not fixing it at the current variable rate that you're in. You're actually fixing it at the market rate at the time you call or ask for the fixed interest rate. Thank you for watching. I hope you learned something today. If you have any questions or anything you'd like me to talk about in the mortgage world, please leave it in the comment section below.